Personally, I never worry about diets. The only carats that interest me are the number of carats in gold. And today, we give you a stock that could be your piece of gold. Honorable judges and distinguished guests, this is Team 5 and we give you romance. We have a buy recommendation with a target price of 14,651 with an upside potential of 29.6%. The company's market cap is 186 billion won with a current and forward PE ratio of 20.7 and 17.4 respectively. The company is a total fashion brand with three major divisions. Jewelry and handbags are offered under the brand J's Tina, while watches are offered under the brand Romanson. The company has grown to become the largest domestic jewelry brand, while handbags rank fourth. Currently, J's Tina plans to expand into China, while Romanson has separate plans to undergo cost reduction. In 2014, the company's total revenue posted 158 billion won, with jewelries composing an approximate half of the revenue. Looking at the number of stores, we expect steady growth to continue, with most notable growth in overseas, while comparatively, the number of watch stores will decrease according to the company's restructuring plan. We will move on to the investment points.
We have a total of 3 investment points with 1 investment point in each of our divisions. First, we will start with the watch division. The watch division posted a massive loss of 4.3 billion won last year, bringing down the company's OPM to 6.5%, which would have otherwise have been 11.2% without such loss. However, such loss-making is expected to mitigate as the company plans to close 35 of its loss-making stores out of its total 59 stores. Costs will reduce mainly from 3 articles, which include sales commission, wage, and fee expenses. The company's restructuring plan is already in action, as the third quarter this year posted only a mild loss of 0.2 billion. Looking from a cost perspective, we expect the company to save 5.2 billion, with the 3 main articles accounting for 4.8 billion. Taking this to a profit perspective, we expect the watch division to post a mild loss of 0.8 billion next year compared to its loss of 4.3 billion last year. Second, we'll move on to handbags. These beautiful J's Tina handbags are expected to continue fast growth in the rapidly expanding domestic market. These stylish, simple bags are the only bags that increase in market share compared to the 3 domestic peers in top 15 average, which had either stayed flat or declined in market share. Such success is attributable to the rising popularity among Chinese customers, who are expected to compose 62% of duty-free sales this year. We expect this trend to be sustainable, as we found a high correlation between handbag revenue and Chinese inbound. Our in-depth analysis shows that Chinese inbound will grow by 14.3% next year, reaching 7.2 million compared to the 6.3 million expected this year. And our third investment point is jewelries. The company strategically chose China and its rapidly growing jewelry market to expand its business. Looking into the market, we see that gold-plated jewelries grew 15.7% in 2014 on back of popularity from younger generations, compared to the 0.5% growth of pure 24K gold. This is a new rising trend. We expect that since the company's 35% of revenue composition is gold-plated, we expect the company to have a sharp edge in the rapidly expanding market. The company, on back of such tailwind, is expected to open 3 more stores, with 1 in SKP Beijing and 2 in Shanghai IFC, operating a total of 4 stores. We expect this to total Chinese revenue, taking into consideration that revenue per department store will reach 1.2 billion compared to the current 0.6 billion of its duty-frees. Now we'll move on to the financials.
Looking into the financials, accumulating cash with the centerpiece of company's financial statement, we expect 16.9% annual growth up to 2020. 3 major accounts will contribute to this. First, net income will grow by 17.7% CAGR. On the other hand, we expect slower growth in the change in working capital. Finally, as a company requires minimum capex, its growth will be limited to 3.1% as well. As a result, we expect 15.5% annual growth of net cash inflow on an annual basis. This leads to the question, what will they do with this cash? We expect 3 major changes. First, funding Chinese operation. Second, paying off liabilities. And finally, increasing dividend. Up to 2018, we expect the overseas business to post a cumulative loss of 3.4 billion. However, even in the worst case analysis where the company generates zero revenue in China, the 13.3 billion raised from exchangeable bond and selling treasury stocks will sufficiently cover the expenditure up to next year. Second, we expect gradual decline in the company's debt position as the company starts to pay it off with larger cash inflow. Accordingly, D ratio will drop to 23% and debt to EBITDA will also fall below 1 by 2018. Finally, we expect the company to continue its healthy dividend policy. Its 5-year average payout ratio was 16.8% with a peak of 22.7% in 2013. As the company starts to make larger profit in the future, we expect its DPS to increase to 325, and its payout ratio will also reach its historical peak of 22% level by 2020. Regarding the cost structure of the company, we expect a 4% drop in the fixed portion to convert a profit. This is attributable to two reasons that enable faster earning growth compared to fixed expenditure. First, as previously mentioned, the firm-wide cost reduction in watch division will take place. And second, we expect an increase in profitability from duty-free stores as inbound growth outpaces store expansion. Bottom line, we expect the company's OPM to increase to 10.3% by 2020. Handbag margin will increase by 0.5%. Watch will escape the deficit and turn to surplus by 2017. Finally, jewelry margin will also rise, but we expect it to be very slow because of the cost from ongoing Chinese operation. Now moving on to valuation.
We derive a target price of 14,601 from DCL valuation, applying 7.29% WACC and 1% terminal growth rate. The two major drivers of increasing pre-cases are growth in top line and OPLAT. Sensitivity analysis to these factors indicate that even in a case of 0.5% terminal growth rate and 1.5% point higher WACC, our target price will be 11,151 with a recommendation of hold. We did a further sensitivity analysis on a bear risk case where GDP growth rate and inbound growth rate dropped by 0.4% point and 2.1% point respectively. It led us to a target price of 11,551 with a 2.2% upside. We also derived target price from our multiple valuation. 5 peers were selected based on similarity in brand positioning and business structures. Their market cap weighted average P ratio of 21.6 and EV/EBITDA ratio of 12.6 led us to a weighted target price of 14,701. Bottom line, equal weighting of the two methods gives us a target price of 14,651 with upside potential of 29.6%. Now we move on to the risk.
We have identified 9 risk factors and categorized them according to their probability of occurrence and impact to the company. We conducted a stress test based on our most notable risk factor, which is the slower economic growth of China that could affect our Chinese inbound and purchasing power. If China GDP's 5-year CAGR falls to 5.2% and 4.9%, our recommendations respectively changes to hold and sell. Further, to better quantify the impact of our 9 risk factors, we also conducted the Monte Carlo simulation. The simulation gave us an assured 71.2% relative frequency for our buy recommendation, while 23.7% and 5.2% for hold and sell respectively. Incorporating our results, we find that our company is resilient to the assist risks, giving assurance to our recommendation. In conclusion, ladies and gentlemen, with the 3 investment points of cost reduction in watch division, and the rising popularity of handbags in domestic duty-frees, and jewelry store expansion plan to China, all backed by a strong cash flow, we recommend a buy rating of a target price of 14,650 Korean won, and the upside potential of 29.6%. Thank you. This is Team5, and now we'll take your questions.
What percentage of sales for this company comes from DFS today?
Sorry, could you repeat the question, please?
DFS, the duty-free sales channel. How important is that? What percentage of sales? If it's different by category and you know, Great. If you don't know the exact numbers, talk me through how important DFS is conceptually.
So first, we'll explain about the jewelries, duty-free. Most of the company's operating margin comes from duty-frees because the jewelry department store and handbag department stores operating margin is only 10% and loss for handbags. However, duty-free's operating margins are higher. And if you look at the revenue per store, we can see that duty-frees are increasing in revenue noticeably, and we expect that this trend to continue because duty-frees are mostly composed of Chinese customers, while department stores are mostly composed of domestic companies.
So just as a follow-on, if duty-free has been a key part of the growth of this company, and China as a nation is trying to domestify its spending on duty-free, so build more Chinese-based duty-free stores so the Chinese can either get it on the way out or on the way back in rather than spend it in Korea. And we've just seen it change in who's licensed in DFS. So instead of having established players like Lotte and SK, we now have new players that have to learn how to do this. Now Shinsegae is one of the licensees who is a department store. Is this a risk to the company?
So to shorten your question, is new expansion of department stores a risk to the company?
So there's a lot going on in the DFS market. It's a highly competitive market. China wants to get the Chinese spending in China, and Korea has just changed who does DFS in Korea, and they need to learn how to do it. Why is that not a problem for your recommendation?
Well, first I must say that revenue per store is increasing. So despite the limited number of stores, we expect each store to do better. And taking into consideration that the company recently gained a share in a new duty-free that gained recognition, which is called SM Duty Free, which is planned to open next year. So adding on another store, and so with the increasing revenue per store and follow-up of higher margins and our entrance to SM Duty Free, we believe that this risk will be covered.
Adding to it, Valuation is only one of the two jewelry manufacturers here in Korea, along with Swarovski, and therefore, and regarding your question about the shift of duty-free operators, we think Valuation can still secure its position, despite the fact that the operator itself actually changes.
Can you tell us what how the competitive landscape for each of their business in Korea? So who are their competitors? Like what the Romance's like the competitive advantage, etc.
To talk with the jewelries first. As you can see in the domestic market, J's Tina is one of the brands that has the highest brand recall, one of the highest brand recalls and initial recognition. This means that customers realize that this brand actually exists, and in their actual purchase, they are reminded of this brand. And as you can see on the right, J's Tina, Tiffany, and Swarovski are the most prominent brands in the domestic market for jewelry. And as you can see, nonetheless, Tiffany is not a direct competitor due to the fact they mainly focus on fine jewelry, which are composed of diamonds, pure 24K gold. And in the case of handbags, we have three major domestic players, MCM, Metro City, and Louis Vuitton. Nonetheless, they have lost their domestic MS, as you have shown in the previous slides, due to the fact that they have deviated from the original message price range. And the most notable factor is that MCM's price range has increased about 2 to 3 folds. And this has deviated them from their message positioning, which has given the disadvantage, and they're losing domestic market share.
Just follow-up question. I get this. I mean, when we talk about the duty-free stores, right? Like basically, we're assuming that the Chinese business will continue, and there won't be much of a change in the composition of how Chinese are traveling. That is the group tour. So, but if Chinese tend to go more free individual travel, they actually would tend to go less of duty-free, or more of, for example, like department stores or some other channels, right? I've seen a number of competitors within each segment. Would this be a risk for the company? Because it seems to me that the Chinese people like their products, because this happens to be Korean products. But if as Chinese people go to some other channels, will this be a risk for the company?
We could have two major points. First, the price itself is different due to tax exemptions, because duty-free sales are more cheaper than the normal department store sales. And the second point is that Tina bags or jewelries, they are more competitive than their competitors in the department store, and it doesn't really matter if the Chinese go to the department store. And what we have found is that the free individual tours are increasing, but nonetheless, at the same time, the demographics of the Chinese are changing rapidly. And what we have seen is that females are increasing of the Chinese inbound, and nonetheless, also the target segment of our age group is also increasing, the 20s to 30s. And as you can see, the red is the composition of that age group. And these tailwinds are becoming more favorable to our company. And we believe that even if those customers deviate to the department store, it will increase our department store sales. Well, nonetheless, the margin is bigger due to the price range.
And additionally, I'm a Chinese, and I can tell you that by now on, the tourists from the third floor or the second floor still prefer the group tour rather than the free tour.
Okay, to follow the Chinese market. One of your key argument is that a key investment idea of this company is that this company will increase its jewelry revenue significantly going forward in the Chinese market. But Chinese market is known as one of the most competitive market, and it's tough market for even for the leading Korean companies. So what makes you believe that this company will make success in the domestic market in jewelry business, and what will be the major challenges to make success in that business?
So you're talking about the Chinese market.
In China.
So to elaborate on our investment point, you can see that the red portion is overseas revenue for jewelries, while white is domestic. This includes our investment point, which is Chinese revenue from department stores. This revenue is not expected to be high, but the company currently has 6 duty-free stores and 1 department store in China. And the company specifically outlined to us that the purpose is not for revenue generation, but for more to increase brand recognition, and actually inside the Chinese grounds, instead of using PPL or other advertisement methods. So the reason why they're expanding to department stores now is because there are more people who visit department stores on average compared to duty-free stores. Because in China, duty-free business is very small, while department store business is 4 times bigger than Korea.
Question in relation to CapEx. One of the things that you discussed is the greater expansion into China and increase in store count and things of that nature. But you make the point of saying that CapEx growth is going to decrease. And I'm not sure I understand how that works, right? If you're expanding, how can you do that if you're spending less on CapEx?
Well, actually, I guess there was a misunderstanding. The negative figure right there was actually does not really represent the decline. Actually, was just a, negative factor. Still, the CapEx will grow, but it will grow only at a slower rate. And the main reason the company requires minimum CapEx is that the company does not manufacture goods by themselves. They outsource 100% of their production to the OEM companies. So basically, they don't need that huge amount of CapEx into manufacturing. And furthermore, we actually observed that looking at the PP&E composition of the company, equipment and fixtures account for 42% of the entire PP, fixed asset. And while land and building, these are not the variable factors in value. And we expect that only equipment and fixture will increase over the course of their expansion into China. And we also observed that PP&E growth and store expansion had a high correlation. So we concluded that these expenditure, most of these CapEx were actually related to the purchase of these fixtures and other daily equipments that the company uses at stores across the region. And as we just mentioned that the store expansion